The causes of the contraction and challenges in the automotive sector are numerous, but I've identified four key factors that I believe are the most significant. The first is the transition to electric vehicles. The high costs of research, development, and production of electric vehicles are eroding profit margins for companies. The second factor is the regulatory and environmental pressures. The introduction of increasingly stringent regulations for reducing emissions has significantly raised the costs of compliance. The third cause is the global slowdown in demand for automobiles. In some regions, the demand for traditional vehicles is declining, driven by both economic factors and changes in lifestyle and consumer habits. Lastly, the shortage of semiconductors and rising raw material costs continue to weigh heavily on the sector. Given the current scenario, and in response to your first question, a repositioning could be advisable, especially for investors with a short to medium-term horizon and a low tolerance for risk. Sectors such as technology, renewable energy, healthcare, and logistics could offer more robust growth prospects. However, I wouldn't overlook the opportunities that remain in the automotive sector, particularly for the most innovative companies that could benefit from the transition to electric vehicles and autonomous driving.
Certainly,
the risk of default for bonds issued by automotive companies could increase, especially for companies with high debt levels, significant financial leverage, and low cash flow generation capacity. This risk is also heightened for businesses that struggle to quickly adapt to new market dynamics, such as the transition to electric vehicles. Additionally, smaller operators with less diversified business models may face greater challenges. That said, despite the current weakening of the automotive sector, we do not believe that large European manufacturers lack the necessary resources to weather these difficulties. Moreover, it is unlikely that governments of major producing countries would leave such a systemic sector, which employs hundreds of thousands of people, without support. On the equity side, the decline in stock prices may have been excessive. The drop has made many stocks attractive, with potential for a short-term recovery. On the bond side, there have been no significant movements. Even long-term bonds have followed the general market trend, which anticipates further consecutive interest rate cuts by the ECB. In the current context, we do not foresee systemic risks for the automotive sector. Instead, we expect governments to pay increased attention to this industry to preserve social stability. It is still advisable to follow these three simple yet essential principles. 1. Diversification. Reduce exposure solely to the automotive sector. 2. Active selection. Focus on bonds issued by leading companies with strong competitive positions. 3. Focus on green bonds. Consider investing in green bonds issued by automotive producers committed to sustainable transitions. In summary, the automotive sector presents significant risks, but also offers opportunities for those capable of carefully selecting the most promising companies and bonds.